Now to all the action from Parliament. The government has agreed to refer the Securities Market Code Bill to a parliamentary panel. The bill seeks to rationalise 4 existing legislations governing SEBI, depositories and government securities into one single code. Opposition says the bill is against the principle of separation of powers. Finance Minister Nirmala Sitharaman said the bill will be referred to a standing committee for further vetting.
Gone through in detail the points which the members who are opposing the introduction of the bill. I think instead of going into details of each one of the objections, I would like to highlight the point that at this stage of introduction, we are only making the bill to be sent over to the standing committee to do a complete review of it, of the bill.
And Sapna Das is standing by with more on the Securities Markets Code Bill. Sapna, what does this bill entail and how will it change the landscape for the securities market?
Well, of course, it's important from many aspects, but a couple of issues that I think we should be able to highlight. One, of course, the first one deals with the fact that this new code also proposes transferring a substantial share of the SEBI's annual surplus to the central exchequer. That is basically the Consolidated Fund of India. So what the code is now proposing is, telling SEBI they have a general fund under which all the collections happen, like, money coming in from grants, fees, and we are also given to understand that this general fund of SEBI, it also earns interest, and via that a lot of other overhead expenses are taken care of. So in essence, SEBI does not have to really depend on the central government for seeking funds. Now what's going to happen is that the bill proposes to for SEBI to set up a separate reserve fund in which 25% of its annual surplus, which comes in the general reserve, in the general fund that they have, that will be transferred. The remaining 75% of the annual surplus that SEBI will have under its general fund, that will be apportioned to the Government of India. Basically, it will come into this Consolidated Fund of India. So that's, that's a bit of a red flag if you talk about it or think about it from the point of autonomy of the regulator. That's one aspect. Second, even in terms of investigation powers, if you look at the fine print of the code, it says very clearly that the investigation officers of SEBI will have to close a case within 180 days, which is basically 6 months. That was not the case so far. And in case they are not able to do that, or they don't have their investigation report ready, then they'll have to explain to the board the reasons for the delay and any kind of extension that they would like to seek. That's second. Third, the code also proposes that once a particular default or a contravention is over 8 years, well, the SEBI will not be able to investigate it. I mean, this is a bit surprising because you look at the fact that there are so many Ponzi schemes around, and for instance, you put money in a Ponzi scheme, so to say, and it matures in 7 to 8 odd years, and there is a requirement of an investigation. That will be difficult on the part of the market regulator. However, there is a small proviso here, provided an investigation agency refers the matter to SEBI, or if the regulator so decides that this could have a systemic impact on the securities market. Only then the investigation can be opened after 8 years, otherwise not.
All right. Thank you very much, Sapna, for those very important details. That bill was taken up in Parliament earlier today, and Sapna, they're outlining the important highlights. Let's move on. The air quality in